Derek Jelinek, one of the healthcare analysts at Morgan's Financial, here to discuss CSL's first half result. While you'd be forgiven for believing the sky is falling and shares fell 5% post the announcement, we believe it couldn't be furthest from the truth. And in fact, it looks like a great opportunity to pick up a quality name at a much better price. While the first half result was softer than expected, about 4%, 50% of that was due to non-operational issues like foreign exchange headwinds, while the other half was due to slower sales in their influenza vaccine division known as Seqirus. This is mainly due to lower immunization rates in the United States. It's been a challenge in the post-COVID period to really get that vaccine rate up, as we're all suffering from a little bit of vaccine fatigue, as we can all appreciate. But we see this more as a temporary hiccup as opposed to a long-term structural impulse. More importantly, the Behring division is a key growth driver, was firing on all cylinders. Gross profit margin moving up, good strong plasma collections, and strong underlying product demand. Also surprised in the half was Vifor. That was their iron and nephrology division, was up. Management also reiterated their fiscal 25 guidance, calling for 10 to 13% profit growth, and they doubled down on their medium-term outlook, calling for double-digit earnings growth. So what was the major problem? What was the market's concern with? We believe it's a second half skew. In order to get to their guidance range, second half would have to grow 15 to 20%. Now in a normal year, this would be a stretch, but this year is quite unique, and I'll tell you why. Well, first of all, seasonality for the base business, normally the skew would put it within 5% of the lower end of its guidance range. So the key question is, can CSL make up the extra 5%? And we believe it can. The Behring division should keep firing on all cylinders. We will see high single-digit growth coming in the second half. It's Vifor, which should improve into the second half. Historically, it's done flat earnings. So coming out of the stronger first half, we're confident that the second half can see a nice uplift. But the big swing factor here is Seqirus. That vaccine division, normally the second half, profitability is flat to down. This year, it looks like it's going to be quite different. This year, we have avian influenza contract wins from CSL from numerous geographies from the US, from Europe, from the Middle East, and they're currently under negotiation with other geographies. So the second half of Seqirus should lift the bar for CSL and get them within the guidance range. So we're comfortable with the forward guidance range. And in fact, we look at CSL as a core holding. Nothing's changed our view or ad rating. And we believe there's a great opportunity to pick up shares in this quality company, as I said, at a much better price.